Hello everyone. Today we're going to talk about stocks and their valuation.
What is a stock? A stock is a form of security that indicates the holder has proportionate ownership in the issuing corporation. Stocks are bought and sold predominantly on stock exchanges, though there can be private sales as well, and are the foundation of many individual investors' portfolios. These transactions have to conform to government regulations which are meant to protect investors from fraudulent practices. Corporations issue, sell stock to raise funds to operate their businesses. The holder of stock, a shareholder, has now bought a piece of the corporation and depending on the type of shares held may have a claim to a part of its assets and earnings. In other words, a shareholder is now an owner of the issuing company. Ownership is determined by the number of shares a person owns relative to the number of outstanding shares. For example, if a company has 1,000 shares of stock outstanding and one person owns 100 shares, that person would own and have claim to 10% of the company's assets and earnings. Corporations issue, sell stock to raise funds to operate their businesses.
Two main types of stock. 1. Common stock. A common stock is a simple piece of ownership in a company. Common stock holders have a right to a company's profits and value, as well as a vote in major decisions and board elections. Common stocks may or may not pay a dividend, and are considered riskier than preferred stock. It has lower priority in event of liquidation than preferred shares. Characteristics of common stock. 1. Major financing vehicle for corporations. 2. Provides holders with an opportunity to share in the future cash flows of the issuer. 3. Holders have ownership in the company. Share in the residual profits of the company. In case of liquidation, common shareholders have residual rights. Shareholders have a claim on the residual assets and cash flow of the company. Claim to all its assets and cash flow once the creditors, employees, suppliers, and taxes are paid off. Voting rights. Participate in the management of the company. Elect the board of directors which selects the management team that runs the company's day-to-day operations. 2. Preferred stock. A preferred stock is a security that requires payment of fixed periodic dividends before any dividends may be paid to the common stockholders. Preferred stock gives investors some level of ownership in a company, but preferred shareholders do not have voting rights. Preferred stockholders have a higher claim on distributions, dividends, than common stockholders. Pays constant dividend as long as the stock is outstanding. Typically has infinite maturity, but some are convertible into common stock at some predetermined ratio. Have preferred status over common stockholders in the case of dividend payments and liquidation payouts. Dividends can be cumulative or non-cumulative.
Stock price versus intrinsic value. There is a significant difference between intrinsic value and market value. Though both are ways of valuing the stocks of a company, understanding the significance of both market value and intrinsic value is crucial for potential investors, as it will help them in making their investment-related decisions with respect to the company's stocks. Now, let us look into the meaning of these two values. What is stock price? Most people assume that the value of a stock is demonstrated by its price. That's only true to some degree. The term stock price refers to the current price that a share of stock is traded at on the market or the price negotiated between a seller and a buyer. The stock's price just shows you the current value of a company or its market value as reflected in an economy. This is because of the fact that such valuation is heavily dependent on the current demand of a company's shares in the stock exchange. Hence, the stock's price would rise if there are more buyers than sellers, and if there are more sellers than buyers, the stock's price would decline. For large, publicly held companies, the price is easily determined because the stock is traded on the stock market. But for private companies, the closely held stock price is more difficult to determine. Now, while it is one of the key factors that investors review when investing in a firm, it is not an ideal parameter as it often carries the risk of misrepresenting a firm's real value. In markets, stocks are often undervalued or overvalued, which in turn could lead to a faulty market capitalization figure. What is intrinsic value? On the other hand, intrinsic value is an estimate of the actual value of a company's stock, different from how the market values it. Unlike the stock price, it is not influenced by many external factors but it's rather based solely on the factors inside the company. Intrinsic value is a type of fundamental analysis. Tangible and intangible factors are considered when estimating the intrinsic value, including the financial statements, market analysis, and the company's business plans. The basic ideology is to make investments in companies that have higher intrinsic or true value instead of those whose value is dictated by the market. What if the intrinsic value is greater than market value, stock price? When a stock's intrinsic value is higher than the stock's market value, it can be perceived by an intrinsic value investor as an advantage to purchase the stock in hopes of getting a gain at its current market value. The investor expects gain because the market is assumed to continue to adjust itself by incorporating more information over time. The stock price then continues to shift towards the intrinsic value of the stock. What if the intrinsic value is lesser than market value, stock price? If a stock's intrinsic value is below the market value, the stock is considered to be overpriced and the investors who rely on fundamental analysis, intrinsic value is a type of fundamental analysis, will most probably not take it. For example, suppose there is a stock whose current market price is 100 pesos and say based on DCF analysis, the intrinsic value of a stock is calculated at 125 pesos. There is a good difference of 25% margin between the two prices. With that, investors can buy these stocks now and wait for its market value to shift towards its intrinsic value. Intrinsic value is a type of fundamental analysis. Discounted cash flow model is one of the methods used to calculate the intrinsic value. Is it possible that the stock price equals to its intrinsic value? Yes. And when it happens there will be what we call stock market equilibrium. If the stock market is reasonably efficient, gaps between the stock price and intrinsic value will not be very large and they will not persist for very long. When a stock is in equilibrium there is no fundamental imbalance, hence, there is no pressure, buying, selling, for a change in the stock's price. Most stocks at any given time are reasonably close to their intrinsic values and thus are at or close to equilibrium. However, at times when stock prices and intrinsic values are different, stocks may be undervalued or overvalued.
Determinants of intrinsic value and stock prices. From the illustration above, the top box shows that managerial actions, together with the economy, taxes, and political conditions, determine stock prices and thus investors' returns. Meanwhile, the second row of boxes differentiates what we call true expected returns and true risk from perceived returns and perceived risk. By true, we mean the returns and risk that investors would expect if they had all of the information that is available about the company. Perceived means what investors expect, given the limited information they actually have. The third row of boxes shows that each stock has an intrinsic value, which is an estimate of the stock's true value as calculated by a competent analyst who has the best available risk and return data, and a market price, which is the actual market price based on perceived incorrect information as seen by the marginal investor. Shown in the bottom box is the occurrence of market equilibrium, which happens when a stock's actual market price equals to its intrinsic value. Common stock valuation. General dividend valuation model. The value of common stock is the PV of the expected dividends to be received plus the PV of the expected price the stock is sold for in the future, where DIT is the annual cash dividend expected to be received by the stockholder in year T. K is the required rate of return on the common stock. N is the number of years and PIT is the market price of the common stock at the end of the year T. Example, suppose an investor expects a common stock's dividends to be 1, 1.05, and $1.10 at the end of each of the next 3 years and expects to sell the stock for $15 in 3 years. If the investor requires a 15% rate of return, what is the stock's value today? To help us value a share of stock, we need to make some simplifying assumptions about the pattern of future dividends. The three cases we consider are: A. The dividend has a zero growth rate. B. The dividend grows at a constant rate. C. The dividend grows at a constant rate after some length of time.
A. Zero growth dividend valuation model. If a company's dividends are not growing, but the company is paying out a constant dividend every year, this is similar to investing in preferred stock. The value of the common stock would be the PV of perpetuity. P equals D over K. Example: suppose a company expects earnings of $5 per share, and because they do not expect to grow, all earnings are paid out as dividends. Thus all future dividends are expected to be $5 per share. If investors require a 10% rate of return, the stock's value today is P equals $5 over 10%. The answer is $50. Treating zero growth common stock as perpetuity seems to imply an investor will hold the stock forever. What if the investor just plans to hold the stock for 2 years and then sell it? What would the stock selling price be in 2 years? P equals $5 over 10%. The answer is $50. This investor expects to receive a $5 dividend for each of 2 years and then sell the stock for $50 in 2 years. The value of the stock today is P equals $5 over the quantity 1 plus 10% plus $5 over the square of the quantity of 1 plus 10% plus $5 over the square of the quantity of 1 plus 10%. The answer is $50. The investor's holding period does not affect the stock's value.
B. Constant growth dividend valuation model. A company with a constant dividend payout ratio and constant return on equity will have a constant growth rate. For example, what is the growth rate for a company earning 12% on equity and a 40% dividend payout ratio? Growth is equal to the quantity 1 minus 40% multiplied by 12%. The 60% answer is again multiplied to 12%, thus arriving at a 7.2% answer. If we expect this company to have earnings of $5 per share in the coming year and the 7.2% growth rate is constant, we can compute the common stock value to an investor requiring a 10% return with the following constant growth model. P is equal to D1 over the quantity K minus G, where G is the expected common rate of growth in cash dividends. The company's dividend in the coming year must be $2 per share. D1 equals $5 multiplied by 40%. The answer is $2. And thus, the value of the stock is $2 over the quantity 10% less 7.2% equals $2 over 2.8% equals $71.43. Why is the value in this example higher than for the zero growth example? Both examples assume earnings of $5 per share and a 10% rate of return. The 7.2% growth rate makes the stock in the constant growth example worth more. Notice in the constant growth example we made no assumptions about the investor's holding period. As we illustrated in the zero growth valuation model, how long the investor plans to hold the stock should not affect the stock's value today. The constant growth model provides good estimates of common stock value when a company's future growth is expected to be stable. The constant growth model provides less accurate estimates when growth is difficult to estimate or large systematic differences year to year are expected in growth. C. Non-constant growth. At times a new company may pay no dividends early in its life but start paying dividends that grow at a constant rate sometime in the future. At other times a new company may pay small dividends initially and at some point in the future start paying dividends that grow at a constant rate. However, as always, the value of the stock is the present value of all future dividends. Many cash flow scenarios are possible in this situation. Example: ABC company does not plan to pay a dividend until year 5. ABC expects the dividend in year 5 to be $1 and dividends in future years to grow at a constant rate of 5%. If the firm's risk-adjusted required rate of return is 13%, what is the value of a share of stock in the company today? P equals $1 over the quantity 13% less 5% equals $1 over 8%, thus deriving at a $12.50. P equals 12.50 is multiplied to the quantity 1.13 raised to negative 4 equals $7.67. When investment analysts use the dividend valuation model, they generally consider a range of growth scenarios. The resulting range of stock prices will be used in establishing a fair price for a share of stock. However, while the dividend growth model is a useful analytical tool, the model is not the last word on stock valuation. Other techniques for valuing a share of stock in a company are available.
Preferred stock valuation. The economic or intrinsic value of a preferred stock is equal to the present value of all the future dividends. Since the preferred dividends are generally fixed, preferred stock can be valued as a constant growth stock with a dividend growth rate equal to 0. Thus the value of a share of preferred stock can be determined using the following equation, where VP is the value, price of a share of preferred stock, DP is the annual dividend per share of preferred stock, CAV is the required rate of return, P is the par value per share of preferred stock, DIP is the annual preferred dividend rate. Example: determine the value of a share of a $1,000 par value preferred stock that pays 8.5 dividends at the end of each year, assuming the required rate of return on the preferred stock is A 9% and B 8%. Note: if the required rate of return is higher than the preferred dividend rate, the preferred stock will have a value below its par and vice versa. The value of a preferred stock will match the par value only when the preferred dividend rate and the required rate of return are equal. Given the above formula and by deriving it, we can solve the required rate of return as follows. Required rate of return equals dividend payment over price of preferred stock.